Go to music. Ladies and gentlemen, the event will begin shortly. Please take your seats as we'll be beginning momentarily. Thank you for being here today.
Welcome to the Michel Camdessus lecture. This is our 12th time we're doing this lecture. It's always a great pleasure to get so many from within the fund and from outside the fund to come here. We're particularly excited to have Chang Rhee, Governor of the Bank of Korea, with us today. Of course, Chang was at the IMF running the Western Hemisphere Department for many years before APD, sorry. APD, for many years before returning to Korea as governor. And my earliest interactions with Governor Rhee, Chang, were around the integrated policy framework. Back in 2018, when we kicked off that work, Chang was very engaged and helped us sort out the direction of travel. And he's going to talk about that IPF and how to think about the future of the IPF as well. Before getting to the lecture, let me introduce the Managing Director, Kristalina, Georgieva, to give the opening remarks.
Thank you all very much for joining us today. It is a great opportunity for us once a year with the Camdessus lecture to bring thinkers that frame the debate and practitioners that take action in a way that impacts their countries and impacts the profession as a whole. It is our flagship event, and it is one that we are always grateful to fantastic speakers. This time around, it is our own Chang Rhee. For the world, he is the governor of the Central Bank of Korea, a very strong figure in the world of central banking. For us, it is this, but it is also a member of the IMF family. So give Chang Yong a big welcome round of applause. And yes, he could have run the Western Hemisphere Department or any other department at the fund for that matter, but indeed he was the director of the Asian Pacific Department, and he as such provided intellectual leadership in a dynamic region, confronting profound challenges and opportunities. He was early to recognize the crucial structural forces such as demographic transition, the forces that are shaping today, continue to shape this region. He also was a pioneer in integrating surveillance and capacity development, which helped increase the ability of the fund to bring to our membership in the region very significant policy ideas and make them practice for the region. As governor of the Bank of Korea, Chang was ahead of the curve in raising interest rates to curb inflation. And I want us all to pause and recognize how significant it was. Now, with hindsight, we all say this is what should have been done. He actually did it. And he skillfully steered the Bank of Korea through challenging times. I want to particularly recognize the credit crunch of 2022. What we will be listening to him today is his ability to turn vision into policy action in the institution. He brought the Bank of Korea to the forefront of pioneering work on digital money and on IA. He has also played a pivotal role as a board member at the Bank for International Settlements, where he chairs the Committee on the Global Financial System, very relevant for the work of the fund. He uses an interesting expression to define central banking. He says it is an art, one that can only be mastered through a judicial blend of economic rigor and pragmatic judgment. He has shown that it can be done. I fondly remember your days here at the fund. We went together on my first trip to Asia, to Thailand, and what I saw there was the immense respect policymakers had for you and for the way you led the fund to be of use to Thailand and to the broader region. Needless to say, we are all recognize here that for many countries in Asia, the fund is mostly affiliated with the East Asia crisis. Still, when I go to some of these countries, I would hear them talking about the IMF crisis. And I think that getting that incredible traction with the governments in the region when you were here is because of that immense art of knowledge, competence, and pragmatism, and care for engaging with our members. The focus of Chang Yong's lecture today, his presentation to us, would be the integrated policy framework. It is something that he led us to bring forward, especially to the countries in East Asia. And I am very keen to hear your reflection on your experience with it. So before I turn the floor to Chang Yong, just let me make very briefly the following points. Point one, we live in a world of profound uncertainty with tectonic shifts in global trade and ongoing geopolitical tensions, all of which have a major impact on growth and inflation. Point two, even in the world of profound change, capital is still flowing across borders, seeking good investments, seeking strong returns. And history has told us that open capital accounts can help channel savings to where they are most needed, improving growth prospects while also creating strong incentive for prudent policy in recipient countries. Equally, flexible exchange rates remain fundamental in helping countries adjust to shocks. Point three, even so, the day-to-day reality for policymakers in many economies is often one of difficult trade-offs in managing volatile capital flows while preserving macroeconomic and financial stability. Given this ground reality, there can be benefits in using additional policy tools beyond fiscal policy, the policy interest rates, and microprudential regulation and supervision focus on the banking sector. And this is what we recognize with the integrated policy framework. It gives policymakers much needed guidance on how best to deploy an expanded toolkit when this is necessary, so as to more effectively manage shocks, strengthen resilience, and reinforce credibility. These IPF tools include foreign exchange interventions, macroprudential policy measures, and capital flow management measures. It is guidance on how to ensure that these tools are effectively applied. And I know that as a practitioner, as somebody who truly led the thinking on these tools, and as a practitioner in applying them, you would teach us valuable lessons in the lecture you would give us today. Let me finish with the following. Our beloved Chang Yong is also a passionate golfer. And as a passionate golfer, he knows that to go over the whole field, you need more than one club. And you need to choose the right club to be successful. And I think what we would hear from you today is applying this experience from golfing into how to use policy tools. So let me thank you very much for taking the time to come. I am delighted that you are this year's Camdessus lecture presenter. Warm welcome.
Thank you, MD, for a very generous introduction. And I'm sure that the fund and you have given me a lot of golf club in my bag so that I can use now. And it's really great to be back. And I promise that I can show you more a natural smile that I used to after this stressful speech. Thank you very much for inviting me today. It's a tremendous privilege to give a speech in honor of Mr. Michel Camdessus, the longest-serving and highly esteemed managing director in the IMF history. Seeing the distinguished speakers who came before me, I feel humbled to be standing at this podium today. Perhaps being an IMF alumnus worked in my favor, and I want to express my special gratitude to Kristalina for giving me this opportunity. When choosing today's topic, the integrated policy framework came to mind without much deliberation. As Paul Krugman noted, it shows IMF's surprising intellectual flexibility, and I believe the IPF is a significant achievement the fund can be proud of. As the director of the Asia Pacific Department, I witnessed this process very closely, observing the countless rigorous debate by the fund economists, research, MCM, and area department, and the difficult task of reconciling sharp differences among member countries. The IPF was built on the intellectual drive and insight of David Litton, Gita, and Tobias in the early stages, and it may not have become the fund's official view without two MDs, Christine and Kristalina, deep empathy for the challenges facing emerging market economies. Today, as a governor of the Bank of Korea, I plan to cover two issues. First, I will look back at how Korea and the IPF have evolved together. In other words, how the framework has guided Korea's policy development, and conversely, how our experience have helped shape the IPF itself. Second, as a newly advanced economy facing rapid population aging, Korea risks reaching the effective lower bound in the distant future. I will examine whether unconventional monetary policy tools, which are widely used in Japan and other advanced economies, can work for Korea, and if not, what alternatives might be available. These tools will be discussed in the context of whether the IPF can be expanded going forward. Among the policy tools within the IPF, the most well-known are foreign exchange intervention, capital flows, management measures, and the macroprudential policies. From an Asian perspective, the starting point of these discussions can be traced back to 1997. At the time, under our IMF program, Korea adopted a floating exchange rate system and restrictive monetary and fiscal policies in line with the Washington Consensus. Malaysia, in contrast, responded with capital controls, which is an unorthodox prescription. Both countries experienced significant economic pain at the time, but recovered quickly. Even today, there is no clear answer about which approach was superior. However, the crisis made one thing clear: the danger of foreign exchange mismatches. Asian economies reached a shared conclusion that external debt management was crucial and building self-insurance through adequate foreign reserve accumulation was necessary. However, when the global financial crisis erupted, they realized this approach alone wasn't sufficient. Unlike the Asian crisis, which stemmed from internal problems, the GFC originated from difficulties in advanced economies' financial institutions. Prior to the crisis, Korea maintained strict FX supervision over domestic banks, but didn't pay sufficient attention to foreign bank branches that sourced massive short-term dollar funding from headquarters. We did not anticipate at all that major global banks could face dollar liquidity shortages, or that hedging-related derivatives trading could trigger serious problems. When the GFC crisis hit, foreign bank branches operating in Korea couldn't roll over their short-term debt, and shipbuilders, which are key export industry in Korea, faced contract cancellation. This delayed expected cash flow inflows, forcing them to buy dollars to close forward contracts previously sold for hedging. The combined effect created a dramatic 60% won depreciation over 7 months, severely destabilizing the FX market until the Fed established temporary currency swap lines with 4 emerging central banks, including Korea. Following the global financial crisis, Korea recognized new need to manage foreign bank branches' FX risk and the derivative-related FX volatilities. We introduced measures to curb capital surges, including caps on FX forward positions and the FX stability levy, extending them to foreign bank branches as well as Korean financial institutions. From Korea's standpoint, these were macro-prudential policy tools. And the IMF Financial Sector Assessment Program happily also acknowledged them as a legitimate macro-prudential instrument. But the OECD, which was initially viewed them as violation of the Code of Liberalization, subsequently amended the code, although that process took several years until 2019. Meanwhile, advanced economies' quantitative easing in the aftermath of the global financial crisis sparked broader interest in the IPF beyond Asia, particularly in Latin America. QE drove capital surges into emerging markets, appreciating their currencies. Brazilian Finance Minister Montega famously declared, "We are in the midst of the international currency war" at the time, arguing that capital control and FXI were legitimate measures of self-defense. These instruments were now recognized not as deviant measures by the few countries, but as policy tools emerging markets could widely adopt. In sum, Korea represents perhaps a unique case, having experienced the necessity and the effectiveness of the IPF tools firsthand at each stage of the development from emerging to advanced economy over the past 30 years. The IPF's FXI guideline identifies 3 frictions warranting intervention to safeguard price and financial stability: FX mismatch, unanchored inflation expectation, and shallow FX market. Before 2000, Korea faced all these 3 frictions. We had substantial foreign currency debt, and neither inflation targeting nor floating exchange rate were well established. However, from the mid-2000s, inflation expectation began anchoring, and from 2014, Korea became a net creditor in international financial market, with these frictions gradually easing. However, when I took office as governor in 2022, FXI still remained necessary due to shallow FX market, the third condition. Later in that year, as the Fed implemented so-called 4 consecutive giant step rate hikes, the $1 exchange rate rose sharply. When the won depreciated faster than market expectations, margin calls were triggered on FX derivative contracts. As market participants scrambled to meet collateral requirement, domestic money market also tightened. While the Bank of Korea recognized flexible exchange rates as important shock absorbers, we had to temporarily intervene to slow the excessive rapid depreciation and buy some time for the market traders to address their margin calls. This experience demonstrates how FXI become inevitable when structural vulnerabilities still exist. Domestically, macroprudential measures have taken on greater importance too. Household debt in Korea has steadily risen to 90% of GDP, which is well above the threshold where it begins to weigh on economic growth. Since I took office, we have worked closely with the supervisory authorities to reduce the ratio toward 80% steadily to enhance capital allocation efficiency. Recently, we decided to slow down the monetary easing cycle in light of macroprudential concerns. Going forward, I believe the day will come when Korea no longer needs FXI and CFMs once our government bonds are included in global advanced economies indices and the ongoing FX reform bear fruits. But I believe still macroprudential policies will continue to be important tools in supporting financial stability. Having examined the IPF's evolution, let me now turn to the more forward-looking perspective. I understand the IPF is currently exploring the inclusion of fiscal policy as another tool. And in addition, I'm today particularly interested in whether the UMP, Unconventional Monetary Policy, could be incorporated as a new IPF instrument. One might wonder how UMP discussion relate to the IPF's original scope, as the IPF focuses on managing external shocks, while UMP addresses monetary policy at the effective lower bound. However, if we take an expansive view that the IPF seeks to coordinate policy instruments to address main frictions in emerging market, I think the discussion of UMP could be integrated into the framework. Global crisis provides several instances where emerging markets have adopted UMPs. Once regarded as taboo, these measures became more acceptable after advanced economy central bank actively employed them, thereby reducing the stigma effect. Indeed, during the pandemic, multiple emerging markets implemented QE alongside large-scale fiscal stimulus. A memorable case for me was Indonesia. In 2020, at the peak of COVID-19, Bank Indonesia launched a burden-sharing program involving direct purchase of government bond in the primary market. And at the time when we challenged these things, Governor Perry explained to me that given the small size of the government bond market, large-scale bond issuance could have pushed up interest rate and risked the credit rating downgrade, necessitating measures to ensure market functioning. Despite concerns over fiscal monetization at the time, the program helped Indonesia overcome the crisis without a credit downgrade and meet its 3% of GDP fiscal deficit target 2 years later as planned. With the pandemic being an exceptional situation, I think market reactions remained relatively benign. Should Korea face similar situation, I'd like to draw on Bank Indonesia's approach while addressing fiscal monetization concern. For example, the government could provide equity to establish a special purpose vehicle, and the central bank could purchase senior bond issued by the special purchase vehicle to channel fund where needed, underpinned by proper governance and transparent exit strategies. Government equity would observe credit risk first, preserving the central bank loss minimization principle while avoiding massive bond issuance and the rating concerns. This approach resembles the U.S. Treasury and Fed Main Street lending program during the pandemic, as Chang and I discussed in an IMF step note. So basically my point is that during the pandemic, emerging market probably should use a QE and other unconventional policy in a crisis period. But my main interest lies not in a global crisis situation, but in whether individual emerging market can use this UMP when facing secular stagnations alone at the effective lower bound. Korea increasingly faced this possibility due to extremely low birth rate and rapid aging, and other Asian emerging markets like China and Thailand face similar risk. In my 2022 Jackson Hole paper, co-authored with Douglas Lexton, we expressed reservation about UMP for emerging market in normal times. These economies typically have fragile fundamentals, heavy fall in currency debt, and unanchored inflation expectation, making large-scale expansion risky for policy credibility and vulnerable to speculative attack. That said, Korea is no longer a typical emerging market. Inflation expectations are well anchored, fiscal discipline is trusted, and Korea has become a net external creditor for over a decade. Therefore, I often hear advice that Switzerland and Sweden, which are small, open, advanced economies, would be more suitable model for Korea. In response to the effective lower bound, Switzerland used large-scale FXI and negative interest rate policy to ease Swiss franc's appreciation pressure, while Sweden chose QE to lower long-term rates. Research indicates that both QE and FXI in these two countries work mainly through currency depreciation. I believe Korea should proceed cautiously in following these two countries' example. Surely, FXI could boost inflation via depreciation in Korea too. But unintended risk could arise as a Korean won is not fully convertible like a Swiss franc and Swedish krona. Persistent expectation of depreciation could spark capital outflows, potentially causing surplus bankruptcy from dollar liquidity shortages, despite our net creditor status. Moreover, if this policy is perceived as targeting export competitiveness, FXI could trigger trade dispute. What about QE, similar to Sweden's? Korea's relatively small government bond market could make it easier to lower long-term interest rate, in fact. However, this might create severe collateral scarcity by draining high-quality liquid assets from the market. In particular, non-bank financial institutions without access to central bank reserve account could face real liquidity strains. Also, if QE shifts our corridor system to a floor system, the low opportunity cost of holding reserves would shrink the interbank market, impairing liquidity redistribution. Experience from advanced economies shows that such market activity is hard to revive once lost. Furthermore, we would confront a dilemma facing advanced economies these days. Potential balance sheet losses from QE normalization could make central bank hesitant to raise interest rate, what Kalman Reinhardt termed fear for hiking. If large-scale losses materialize, both institutional levitation and operational independence could be compromised. Indeed, the Fed and ECB seems now appear to be taking more cautious stance about the potential side effect of QE. Most importantly, policy effectiveness of these policies is questionable. As seen in Japan in early 2000s and Sweden in the late 2010s, even when QE lowers long-term rates, its impact may not reach households and companies effectively. In Korea, currency depreciation now offers smaller export benefit due to supply chain relocations and the dominant currency paradigm, while posing a greater financial stability risk through potential non-linear depreciation in our shallow FX market. In such circumstances, large-scale QE would more likely fuel real estate inflation than stimulate the real economy, further worsening our already critically low birth rate. Given these all considerations, my temporary conclusion is that FXI and QE appear to be ill-suited or risky option to Korea when we face an effective low bound. Then, as an alternative to UMP, today I'd like to propose considering a funding for lending scheme, despite I know this is going to cause a lot of potential controversy here. In funding for lending scheme, central bank provide low interest rate funding to private financial institutions, which then channel credit to targeted sector. In fact, funding for lending is more widely employed by central bank worldwide, both advanced and emerging markets, than many realized. Korea also have long used this lending facility known as the Bank Intermediated Lending Support Facility. In the 1980s, it functions as an automatic rediscounting system for commercial papers with a strong industrial policy focus, and the scale at the time reaching over 10% of GDP at its peak. Today, this program has shrunken to about 1 or 2% of GDP amid growing calls for its abolition, given its quasi-fiscal nature. Yet, our recent decision early this year shows this facility's potential to complement monetary policy. In Korea, unexpected and unnecessary martial law declaration last December, I still do not understand why it happens, caused the economy to contract sharply. Consumer sentiment and domestic demand, especially sales by the self-employed, plummeted, warranting rate cuts. However, at the January Monetary Policy Board meeting, we maintained rate because political uncertainty had turned overseas investor sentiment negative, causing our currency to fall to its lowest level since the global financial crisis. So rather than immediately cutting rates, we used the lending facility to provide targeted support to the self-employed and the small and medium enterprises while waiting for the political uncertainty to ease. This illustrates how such targeted measure can address the limitation of interest rate policy as a blunt tool. So the question is, could this lending facility serve as an alternative when interest rate approach the effective low bound? As textbook tells us, fiscal policy is more effective than monetary policy in a liquidity trap. And monetary policy should not become the only game in town. In that context, I wonder whether quasi-fiscal tools, such as funding for lending, could be more effective than UMP. I'm fully aware that the use of quasi-fiscal tools has long been controversial in the central banking community, particularly at the IMF, and regarding fiscal dominance and the central bank independence. So I still understand that concern. However, let me try that we may have a slightly different view for two reasons. First, QE is not completely immune from criticism of this nature, as it effectively supports government financing by relieving debt service burden. Moreover, to lower long-term interest rate, QE must be implemented on a large scale, making it difficult to avoid side effects such as asset price inflation. If risky assets also are purchased, it may be perceived as bailing out financial institutions rather than supporting the real economy, contributing to public distrust of central banks as reflected in movements like Occupy Wall Street. As an unelected power, central bank and their independence are more vulnerable than elected officials to the loss of public trust. Second, theoretically, when specific sectors are particularly depressed, it is socially optimum to channel wealth toward those who spend more in those sectors, boosting demand where needed most, though private agents fail to internalize this benefit. This aggregate demand externality can justify targeted monetary policy intervention like funding for lending. In this context, just as ongoing work on the PFs incorporate fiscal policy, I wonder whether funding for lending can be introduced as an additional policy tool for the IPF. Needless to say, employing funding for lending requires careful institutional design to mitigate risk of fiscal dominance and independence erosion. This should include reasonable quantity limits, usage restriction, and the exit strategies, all predetermined. Government credit guarantee must be provided when the lending facility exceeds a certain scale, which is a practice adopted by several countries during crisis. With that in mind, I hope that IMF could explore whether this approach could be a valuable addition to the policy tools. And I know that there are a lot of qualifications, but this is, because I think there is a limitation of QE. I'm looking for the alternative. That's my problem. Okay. Before concluding, I'd like to say a few words about another tool relevant to effective lower bound situation, forward guidance. And following the global financial crisis, advanced economy central bank actively used unconditional forward guidance to escape the effective lower bounds, providing information about future monetary policy qualitatively or based on specific time frame or threshold. While multiple experiences proved unconditional forward guidance effectiveness in signaling, many studies show that the unconditional forward guidance is quite effective in signaling policy commitment. Most central banks have now turned away from it after the post-pandemic experience because this unconditional commitment make the policy flexibility quite difficult. That said, I don't believe conditional forward guidance should also be ruled out. Conditional forward guidance presents an endogenous interest rate path consistent with the economic outlook. Previously, the Bank of Korea maintained the very strict view that even conditional forward guidance was problematic, concerned that market might interpret guidance as a promise despite its conditional language, and the credibility would suffer if rates deviate from pre-announced levels. However, this conservative approach withholds useful information from the markets and weakens incentive to enhance internal forecasting capacities by avoiding external scrutiny. To improve this practice, the BOK is conducting forward guidance pilot tests these days. STEP present quarterly growth and inflation forecast for the next 2 years alongside corresponding interest rate paths. 6 monetary policy board members, excluding me, then indicate their views on the path for the next year using dots. While the growth and inflation forecasts are made public, the interest rate passes remain still internal. Instead, we publish dot plot showing board members' view over the 3-month horizon, which market calls the K-dot plot. If this system takes roots with expanded horizon, we expect it to become an effective channel for monetary policy communication, including on the effective lower bound. Let me wrap up with some final thought. I have discussed the historic development of IPF and various policy tools that Korea and the other emerging economies might consider in an effective lower bound situation. But considering that the effective lower bound risk in Korea is mainly driven by structural factors like population aging and the low birth rate, I believe the best policy to counter the effective low bound is not reactive fiscal or monetary policy expansion, but proactive prevention through structural reform. I'm very glad that the former Japanese governor, Mr. Shirakawa-san, also emphasized this in his book. This is why, since taking office as a governor, I have led the Bank of Korea to expand its research beyond the monetary policy to include structural issues tied to long-term growth, such as labor force participation, immigration, and regional development. These are the type of reforms that address root causes rather than symptoms. Nevertheless, we must be prepared for the possibility that we may inevitably enter an effectively law-bound environment in the distant future. The policy options I suggest today will surely be controversial, but I look forward to the IMF's continued engagement on this critical issue and the development of a richer playbook for the policy responses. In sum, I hope that Korea's IPF story, forged during its journey from an emerging market to an advanced economy, can serve as a useful reference for other countries navigating similar transitions. And, this is probably the end of my speech, but though it may not be appropriate for this lecture, I'd like to conclude by expressing my deep gratitude to the friends at the fund for training me for last almost 10 years and supporting me through COVID-19 and giving me a second life, and also continue to help me in leading the Bank of Korea. For my experience was at the fund was one of the blessings that God gave me, and I really appreciate it. Thank you so much.
This was excellent. Thank you. I think we would all agree that was incredibly substantive, comprehensive, and giving some ideas for us. Controversial is not bad. We need, in a world of dramatic change, we actually do need to think beyond the concepts we are comfortable with. So we have a bit of time. We have a chance to talk a bit more with Chang Yong and take advantage of his practitioner experience as well as of his very deep analytical capacity. And I want to start by going to the IPF. Countries, broadly speaking, are very interested, but not all countries are ready to step forward and use IPF. So if you were to give advice from a Korean experience, how should they judge the costs and the benefits of foreign exchange interventions, capital flow management measures? What would you tell them to give them more comfort that it is there for them to deploy?
Thank you. I do not think IPF is a separate policy tools. I believe that the IPF is tools that we can combine with traditional policy advice. And to make IPF work, there are a lot of preconditions. For example, I think IPF cannot replace the sound macroeconomic policies. And also, for example, FXI, in order to FXI to work, you need a certain amount of sufficient foreign reserves. So I think there are a lot of preconditions. And IPF is definitely not a pure cure for all. And having said that, I think also from Korean experience, if I just make an example of FXI, the objective and the reason why we have to use these things has been evolving across time. For example, before 2000, if I talk about FXI, in some sense, we were at the time were very concerned about the sharp depreciation as well as appreciation. Because appreciation, because we are an export-oriented country, it may hurt the competitiveness of our export sector. depreciation because we have a large external debt and we worry about balance sheet effect. But as time goes by, now Korea export companies are now producing a lot of goods in outside. So, and then also many Korean investors have a lot of overseas investment. So now we are a net creditor international market. So no longer that depreciation help somebody and appreciation hurt somebody in years. So all these things, depending on the circumstances, countries adjust to what to use.
Thank you very much for this, and I could not agree more that you need strong fundamentals. It is not a substitute for it. Something that is on everybody's mind these days is we operate in a world of more uncertainty, more frequent shocks, and all institutions, central banks included, need to figure out how to perform their functions in this world of more uncertainty. So in your case in Korea, what do you do differently? Do you do more in scenario analysis? How do you figure out how to deal with this world of uncertainty, given that it's here to stay?
Yeah, I think, as a small open economist, we have been lived with uncertainty. So it's not a new thing, but the problem is a lot of, unexpected uncertainties. So Krishna is here, but I'm very happy that I'm no longer APD director at this moment. For example, like that kind of uncertainty really is important. But since you mentioned the scenario analysis, so if I just go on to these technical things, we are reading the Bank of England and the ECB's scenario analysis very carefully. But we have been doing the scenario analysis, but in a slightly different way. We have a baseline scenario, but given the lot of uncertainties that we had, we used to publish our scenario analysis in a risk part. So we are using it as an alternative to the pen chart. But on the other hand, it looks like when I look at the BOE and the ECB report, they seem to suggest scenario analysis as an alternative scenario to the baseline. We will look at it, but I think I have some concern. One is that whenever you present alternative scenarios, market just look at the one point estimate from the baseline scenario. And also, scenario analysis that we are publishing at Bank of Korea is based on only the staff's opinion. But if I have to bring this scenario analysis to the board level, then in addition to reaching the agreement on interest rate, we have to agree on what scenario we have to do it, and that will make a lot of difficulties. So we are actually looking at how the Bank of England and the ECB is solving these problems. We're interested in.
Well, and of course you will contribute to this obviously for Korea, but also for the rest of the world. One thing that is in your lecture, but also in the realities you operate within, is low inflation, low interest rate environment. And at the same time, we live in a world in which in other jurisdictions, it is the opposite: high interest rate, higher inflation, higher interest rate environment. How do you see your world of low interest, low inflation, and how do you see operating in a world in which there is significant divergence in pathways for central bankers?
No, actually, I think Japan is in the case that you just mentioned, but in case Korea, we are not still in the low inflation and the low growth environment yet.
But you're thinking that you may be there.
Maybe in distant future. But at this moment, we experience quite a rapid inflation also from 2022. So,
right, yes. Yep.
So we had to tighten our interest rate quite rapidly too. And at this moment, inflation is relatively around 2%. I'm very happy about it. But still, the growth rate, partly due to this political turmoil this year, which make our growth rate in the first 6 months almost zero. And then together with the low growth rate and also our trade negotiation with the US continues, a lot of uncertainties actually depress our growth at this moment. So we have to this is why big homework. and there are a lot of uncertainty, and we have to probably look at the data and then make our decision. But at least by looking at Mr. Powell's speech yesterday, I'm very happy that our inflation is 2%. So my mandate is okay.
I guess the broader question here is we have been in a world in which major central banks face the same challenge, high inflation, needs to tighten. They were in a place when inflation was not a problem, but stimulating the economy was dominating, and they all did the same thing. Yeah. Monetary policy accommodation for one, tightening for the other. How do we operate in a world in which there is divergence? Different countries face different levels of inflation, different pressures, and yet we have a world economy that is still quite interconnected. How do you see this world?
Actually, I think I have to confess that when I was in this building, always I was thinking about how we're going to coordinate international policies for the benefit of the whole global economy. But once I moved to my office in Korea, now I'm just thinking about my policy and how this will affect my own country. So, but having said that, I think inflation targeting, still many literature show its effectiveness. I believe inflation targeting is a good framework for many countries. To me, I won't explain the economic and empirical literature, but for me, inflation targeting is a good tool for me to shrug off many political pressure, and then whenever there is a request for me to do something, I can always say it's not my mandate, so that the central bank can have a more longer-term perspective. So I think, so in some sense, globally, I think inflation targeting is a good framework.
Yes, that's very good, well said. And I think we want you to come here every so often, so you're out of your office in Korea, and what is happening in the world is your business. Let me. One thing that I was very worried about, we are very worried about, is a world in which non-banking financial institutions are growing in their significance. How much is this of an issue in Korea? To what extent you have thought through how to deal with it?
This is a real problem, and even my short period as a governor, I'm facing this problem very seriously. So around 2022, when we raised the interest rate quite rapidly, because of the accumulated leverage in our construction and the real estate sector, we are very careful not to break the bubbles at certain time and having it lead to the financial difficulties. At the time, most of the lending in the real estate sector, we found that was done by the non-banking sector, especially non-banking deposit institutions. And because the bank was very strictly regulated, so, but by, this non-banking sector is growing. It's already more than 50% of Korean financial market, and they are less regulated. So this become a problem. And then the same problem, and then actually when the Silicon Valley Bank issues become a problem in early 2023, we were really concerned because non-banking deposit institution also we provide deposit insurance, but a lot of deposits which is well above that amount, and bank run by this non-banking financial institution can be very rapid. So this become a real issue. And my view is that unlike large economies with a very resilient and strong financial sector, country like Korea, I think financial stability is a very essential issue. So for example, like when you consider neutral rate of interest rate, for example, I think that I focus more on the neutral rate when we consider financial stability as a goal too. So that is one of the reasons why we want to maintain slightly higher interest rate than the others to see how this financial stability concern is addressed.
I'm sure there would be a lot of discussion in the future on that and how it is handled. It's very good to have also the Basel Group, the international bank, the Bank for International Settlements, bringing this topic. One thing we cannot let you off the hook on is what is happening with stable coins, what is happening in that environment.
I think
Is the one coming in?
Yeah, actually, this suddenly become a political issue in Korea too, because many politicians says we need to develop Korea one-denominated stable coins in order to cope with the rising surges in a dollar-denominated stable coin. If we don't issue the one-denominated stable coin, our Korean economy will be dollarized soon. So, but I cannot agree. But still, it's like a lot of marketing and many things are going on at this moment. So we have some concern, like other central bank, that this issuance of the stable coin may may have some problem in maintain singleness of money, and then maybe free banking era that we know what of the problem of the many free banking and the non-bank issue, this non-sovereign money is available. So that's the problem. But on top of it, Korea has a special reason why we have more concern. Still, we have a capital, not a fully convertible currency, and we have some capital flow measurement policies. But if we allow the one-denominated stable coin, then means that the Korean citizens can have one deposit outside Korea, which really means that liberalizing capital, liberalization. And maybe it's a good policy, but I don't know at this moment. So a lot of complexity at this moment.
Well, we will certainly invite you to come again and tell us what happened. And obviously, when we talk about stablecoins, that takes us into the world of artificial intelligence. In other words, in the world in which technology presents new opportunities and new challenges. I have two questions for you. The first one is, have you been already subject to a fraud attempt, somebody presenting you to the public and selling you to the public? In other words, are you seeing the danger of deep fake in your personal life?
Mike, still I'm very happy that I haven't seen very serious issue for myself, but I see several ministers and have this kind of problem already. So I'm lucky. Probably I'm not good looking enough to be in that, but I think so far I'm happy that I'm not one of them. Yeah.
Well, and the serious question is, how do you see the role of artificial intelligence in terms of making your work as a central banker more effective, more productive, more efficient, but also riskier in terms of new financial stability risks?
Like the fund, actually, I have to be grateful to the fund staff that I sent our Bank of Korea staff to here to see how the IMF is using the artificial intelligence. So we actually benchmarked it, and also we invest a lot, like IMF, to catch up with the trend. And we are using the AI for drafting, reading, and summarizing, translating, and we developing the chatbot for the to our daily administrative work. So we are doing a lot. One difference that we have from IMF and others is sovereign AI, because Korean law do not allow us to having a database outside of Korea. So in order to use a cloud computing, we have a certain constraint using the outside vendors. And luckily, Korea is one of the rare countries which have an ability to produce AI things within ourselves. So partly as an industrial policy, Bank of Korea is working with one of the local company to develop our own sovereign AI using the Bank of Korea system. So I don't know how well it's going. I really hope that Korea still remain as one of the country who can have a own AI industry. So, but we'll see. But for the time being, we are working with a Korean company to develop the AI system for Bank of Korea.
And it is an area where a lot is happening very fast. So good to continue that conversation. Chang Yong, in your lecture, you touched on some of the topics that you believe the IMF has to be engaged in. We should step into the debate on those. Now, imagine, you told us you're so glad you're not in Krishna's shoes. But imagine that you are in Krishna's shoes. Imagine you're here. Imagine you're here at the fund. What advice do you have for us? Where do you see the most impactful activity of the fund in the years ahead?
You know, I think when I was first become an APD director, I really emphasized that the importance of becoming a family doctor rather than just the emergency room doctor. I think that still is the right approach, especially true too, because in this lot of uncertainties, definitely there will be more accident and more countries more willing to get help from the IMF. So IMF role, I think, is increasing rather than decreasing in terms of demand. But when I talk to several Asian policymakers, I don't know how much I can be candid, but they have some concern too, because now, given all these tensions, the governance of the IMF and also whether there can be easy agreement among major shareholders. So even though IMF has many emergency tools, whether countries can use it in time, there are several people who is kind of concerned on that. Because of that, I think just emphasizing the crisis financing will be difficult. But on the other hand, because uncertainty is rising, I think as a family doctor, you consult with the country and exchange views how to avoid the crisis and what you can do preemptively, all these things. That kind of demand is rising. And that is also why we focus on the capacity building. So IMF role as an emergency doctor is still important. But I think while there are a lot of other issues which may limit your ability to do so, maybe the other area, consulting and also helping and giving advice on this, the other area, that will be very important.
Well, that is, I'm sure people would agree that the most important function of the IMF, the surveillance function, and how it impacts programs, how it impacts capacity development in a world of uncertainty does come with a premium. When we do the Camdessus lectures, we do not call for questions from the audience, but you're one of us, you have some of your colleagues, so I'm going to make an exception and see whether there is anybody who wants to put a question to you. I'm looking around to see whether there is any hand in the air. Put a question, a wish that would come true. Any of the, where is Krishna? Your chance to ask him for advice when he is here.
We talk it every day.
Okay. Anybody in the audience? Any questions from the audience? I think people are shy to ask. There is one, please.
Not bad.
Hi, Beth Ann Wilson from the Federal Reserve Board. Really, really appreciated your remarks. Lots and lots of food for thought. One thing I was thinking about, and it was touched upon in one of the questions, is with the framework, a lot of the point of it is to slow down flows, give companies and policymakers time to adjust. We're in a world where there's lots of pressure coming from the digitalization advances, stablecoin, cross-border payments issues, AI, that will speed up flows. How do you see those tensions, and how do you see this framework being used in that kind of environment?
You mean IPF?
Yeah, IPF, sorry.
I think IPF does not necessarily mean that it slows down all the flows and policy actions. I may be misunderstood, but I think IPF is more like using different tools and depending on the circumstances. So, for example, I think that if you think, one example that you mentioned, if the digitalization of economy make this flow, especially let's say deposit run much faster, then I think we need a interest rate policy or traditional tools may not be sufficient. Then we need additional tool, and that is what why we discussing at the BIS pre-positioning of collaterals or collateral management, other things like that. So to me, so far IPF is focused only on the external side and such as the capital flow measures and capital control. But I think as economy develop in a certain direction that we we couldn't expect it before, I think another tool may be needed. So then that is what I'm saying, that probably this toolbox can be expanded. So.
Very good. We are coming to the end of this session. Chang, I very vividly remember your service to this institution and the incredible courage you demonstrated when COVID hit. Many may not know that, but Chang got very seriously ill during COVID and has dealt with this with tremendous perseverance, and as I said, with a lot of courage, did not abandon his job even in the worst of moments. So I want to tell you a story that stays with me. We had regular calls, and I learned from his wife that while he was really having difficulty just to get out of bed, when he would have a call with me, he would sit. She didn't tell me whether he would put a suit and a tie,
I know.
but he would take that with the discipline of it is a professional obligation to be in his best, even when he was in such a difficult moment. And of course, we celebrate the fact that you came out of it strong. Not only you came out of it strong, but you are serving your country with such professionalism, making us all, your friends here at the IMF, your IMF family, very, very proud. Thank you, Chang.
Thank you. Thank you. That you probably don't remember, but your phone.
Thank you, everybody, for being here today.